On January 27th, 2025, at 11:42 in the morning Eastern Time, a portfolio manager at BlackRock's fixed income desk in New York received an alert on his Bloomberg terminal. The alert showed a sudden spike in interest rate volatility. Not the kind of volatility you see from economic data releases or inflation reports. This was political volatility. Futures contracts tied to Federal Reserve policy expectations had just repriced dramatically within 60 seconds. The market was responding to a rumor that had leaked from a Trump transition team meeting the night before. A rumor about who would replace Jerome Powell as chairman of the Federal Reserve when Powell's term expires on February 2nd, 2026. The name being floated was Kevin Warsh. And if you understand what Kevin Warsh represents, if you understand the bets that BlackRock has made over the past 3 years, positioning $10 trillion in client assets, then you understand why that portfolio manager immediately forwarded the alert to his chief investment officer with a single word in the subject line: problem. Welcome to Economy Meet History, where we decode the financial decisions shaping your future by connecting them to the patterns that have defined empires for thousands of years. And what we're about to discuss is not just a story about who leads the Federal Reserve. It is a story about the single most important financial institution in the world, potentially shifting direction at exactly the moment when the world's largest asset manager has positioned $10 trillion to go the opposite way. Before we dive into what happens when those forces collide, and they are going to collide, I need you to do something critical. Subscribe to this channel right now and hit that notification bell. Because what I am about to explain is developing in real time, week by week. And when May 15th, 2026 arrives, you need to understand what just happened to your retirement account, your mortgage rate, and your savings before your financial advisor even knows what hit them. Also, comment below and tell me this. Do you think the Federal Reserve should prioritize stopping inflation even if it causes a recession, or should it prioritize keeping people employed even if inflation stays higher? Because that philosophical question is about to become very, very real. Let me start with what we know for certain, because in a moment I am going to show you what the data strongly suggests, but I need to establish the facts first. Jerome Powell's term as chairman of the Federal Reserve ends on February 2nd, 2026. That is not speculation, that is not a rumor, that is federal law. Powell was appointed by Donald Trump in 2018 for a 4-year term. He was reappointed by Joe Biden in 2022 for a second 4-year term. That term expires in 13 months. Now, Powell will still be a member of the Board of Governors until 2028, which means he could theoretically continue serving as a governor even if he is not reappointed as chair. But the chair position, the person who runs Federal Open Market Committee meetings, the person who testifies before Congress, the person whose every word moves global markets, that position will be open. And here is where it gets interesting. Donald Trump, who will be president when that decision needs to be made, has a complicated relationship with Jerome Powell. Trump originally appointed Powell, but then spent most of 2019 and 2020 publicly criticizing him for not cutting interest rates fast enough. Trump wanted lower rates to goose the stock market and the economy heading into his re-election campaign. Powell resisted. Trump could not fire him because Fed chairs have statutory independence, but Trump made it clear he was not happy. Then Biden reappointed Powell in 2022, which meant Trump did not get a chance to replace him during Trump's hypothetical second term, except now Trump does have that chance because Powell's term expires during what is Trump's actual second term. So the question becomes, does Trump reappoint Powell for a third term, or does he choose someone new? And all indications from people close to the Trump transition, from market analysts, from Washington insiders, suggest Trump wants someone new. Someone more aligned with his economic philosophy, someone who will be more responsive to political pressure to cut rates when Trump wants stimulus, someone younger who could serve a full 4-year term and potentially be reappointed for another 4. And the name that keeps coming up, the name that has been circulating in financial circles since November, is Kevin Warsh. Now, if you have never heard of Kevin Warsh, let me give you the background because it matters. Kevin Warsh was a Federal Reserve governor from 2006 to 2011. He was appointed by George W. Bush when he was only 35 years old, one of the youngest Fed governors ever. He served during the financial crisis. He was in the room for all the emergency decisions: the Bear Stearns bailout, the Lehman collapse, the AIG rescue, the first rounds of quantitative easing. After he left the Fed in 2011, he went to Stanford, where he is now a distinguished visiting fellow at the Hoover Institution. He also advises corporations and occasionally writes op-eds criticizing Fed policy. And critically, Donald Trump considered appointing Warsh as Fed chair in 2017. Trump interviewed him. Warsh was on the short list. Trump ultimately chose Powell instead, partly because Powell seemed like a safer, more establishment pick. But the fact that Trump considered Warsh 8 years ago means Warsh is already vetted, already in Trump's orbit, already someone Trump respects. Here is what you need to know about Warsh's economic philosophy, because this is where the collision with BlackRock begins. Warsh is a hawk on inflation. A hawk means he prioritizes price stability over employment. If he has to choose between keeping inflation low and keeping unemployment low, he chooses low inflation. He has been publicly critical of the Federal Reserve for keeping interest rates too low for too long during the 2010s. He argued that quantitative easing, the Fed's program of buying trillions in bonds to stimulate the economy, was distorting markets and creating asset bubbles. He wrote an op-ed in 2013 calling QE monetary morphine, arguing it was addictive and would cause long-term damage. And critically, in 2021 and 2022, when inflation started spiking, Warsh was one of the loudest voices saying the Fed was behind the curve, that they needed to raise rates faster and harder to crush inflation before it became entrenched. Now, Jerome Powell eventually did raise rates, from 0 in March 2022 to 5.3% by July 2023, the fastest tightening cycle in 40 years. Inflation came down from 9% to around 3%. But Warsh's view is that Powell should have started earlier and should stay restrictive longer. Warsh does not believe in the soft landing that Powell is trying to engineer. Warsh believes you fight inflation until it is dead, even if that causes a recession, because a recession is temporary pain, but embedded inflation is permanent damage. That is the philosophy. And if Kevin Warsh becomes Fed chair in 2026, that philosophy will guide policy. Now, let me show you what BlackRock has been doing while all this is unfolding, because this is where the $10 trillion bet comes in. BlackRock, for those who do not know, is the largest asset management company in the world. They manage $10.01 trillion as of the fourth quarter of 2024. $10 trillion. To put that in perspective, that is roughly 40% of US GDP. That is more than the total value of all the gold ever mined. BlackRock manages money for pension funds, sovereign wealth funds, endowments, insurance companies, and millions of individual retirement accounts. If you have a 401k or an IRA, there's a very good chance some of your money is in a BlackRock fund, probably an index fund tracking the S&P 500 or a bond fund. BlackRock's business model is simple. They collect fees based on assets under management. The more assets they manage, the more fees they collect. And asset values, whether stocks or bonds, are enormously sensitive to interest rates. When interest rates are low, asset prices tend to be high. Stocks trade at higher valuations because future earnings are worth more when discounted at low rates. Bonds are worth more because existing bonds paying higher rates than current market rates become valuable. Real estate prices rise because mortgages are cheap. Low rates are good for asset managers. High rates are bad. And here is what BlackRock has been positioned for over the past 2 years. In 2023 and 2024, as the Fed was raising rates and inflation was coming down, BlackRock started positioning client portfolios for the next phase, which they believed would be rate cuts. Their analysis, shared in quarterly letters and investor presentations, was that inflation would continue falling, the economy would slow but not collapse, and the Fed would start cutting rates in late 2024 or early 2025. They increased duration in their bond portfolios, which means they bought longer maturity bonds that would rise in value when rates fell. They maintained heavy equity exposure, expecting stocks to rally when cuts began. They reduced cash positions because cash yields would fall when the Fed cut. This positioning made perfect sense if you believed Jerome Powell or someone like Powell would remain in charge. Powell has signaled repeatedly that once inflation is under control, he will cut rates to avoid unnecessary economic damage. He wants a soft landing. He wants to bring inflation down without causing mass unemployment. That is the goal. And if that remains the goal, then yes, rate cuts are coming. BlackRock's positioning wins. Bond portfolios appreciate. Stock portfolios rally. Clients are happy. Fees keep flowing. But if Kevin Warsh becomes Fed chair, that entire scenario changes. Warsh does not care about a soft landing. Warsh cares about killing inflation completely. If inflation is at 3% and the Fed's target is 2%, Warsh keeps rates high until inflation is at 2%. If that causes unemployment to rise from 4% to 6%, so be it. If that causes a recession, so be it. Temporary pain is acceptable. Persistent inflation is not. And under that framework, rate cuts do not come in 2025 or even 2026. They come when inflation is truly dead, which could be years. Now, I want to be very clear about something. I do not have a document that says BlackRock officially bet that Jerome Powell would be reappointed and is now panicking because Kevin Warsh might get the job instead. That is not how this works. BlackRock does not publish their internal political forecasts. But what I can show you is their portfolio positioning, which is public information disclosed in SEC filings. And that positioning only makes sense if they expected a dovish or moderately hawkish Fed going forward. If they expected a Warsh-style ultra-hawk, they would have positioned very differently. They would have shorter duration bonds. They would have more cash. They would have more value stocks and fewer growth stocks. They would be hedged for a prolonged high-rate environment. They are not, which means either BlackRock made a massive analytical error, or they did not expect someone like Warsh to take over. I am betting on the latter. They expected continuity. They expected more Powell, or someone Powell-like. And if Warsh gets the job, their bet failed. Now, let me address the May 15th date, because you're probably wondering where that comes from. The presidential nomination process for a Fed chair works like this. The president nominates a candidate. The Senate Banking Committee holds hearings. The committee votes. If the nominee passes committee, the nomination goes to the full Senate for a floor vote. If the Senate confirms, the nominee is sworn in and takes office. This process typically takes 2 to 3 months, from nomination to confirmation, assuming no major complications. Jerome Powell's term ends February 2nd, 2026. If Trump wants a new chair in place immediately, he would need to nominate in November or December of 2025. Hearings would happen in January, confirmation in late January or early February. The new chair takes over seamlessly, but that assumes Trump moves quickly, and Trump does not always move quickly on appointments. A more realistic timeline is that Trump nominates someone in January or February of 2026, after Powell's term has already expired. In that scenario, either Powell stays on as acting chair, or the vice chair steps in temporarily until the new chair is confirmed. If the nomination happens in February, hearings in March, and the Senate vote in April, you are looking at a late April or early May confirmation. May 15th is right in that window. It is also exactly 100 days after Powell's term expires, which feels like a symbolic marker. 100 days of transition. Whether May 15th is the actual date or not, the important point is this. By mid-2026, there will almost certainly be a new Fed chair. And if that person is Kevin Warsh, the financial markets are going to reprice dramatically. Let me walk through what happens in the days and weeks after Warsh confirmation, because this is where it gets real for you. The moment the Senate confirms Warsh, probably with a 65 to 35 vote, markets will react. Bond yields will spike. The 10-year Treasury, which is currently around 4.3%, could jump to 4.7 or 4.8 within hours. Why? Because bond investors will immediately price in the expectation that the Fed is not cutting rates anytime soon. If rates are staying higher for longer, existing bonds paying lower rates lose value. Yields rise to reflect the new reality. Stock markets will sell off. Not catastrophically, but noticeably. The S&P 500 might drop 5 to 7% in the first week. Growth stocks, especially tech stocks with high valuations, will get hit hardest. Why? Because high valuation stocks depend on low interest rates to justify their prices. When rates rise, those valuations compress. A stock trading at 40 times earnings might drop to 35 times earnings, just because the discount rate increased. That is a 12% decline from valuation compression alone, before any change in the company's actual business. The dollar will strengthen. Higher interest rates attract foreign capital. Investors will buy dollars to invest in higher-yielding U.S. assets. A stronger dollar is good for Americans traveling abroad or buying imported goods. But it is bad for U.S. exporters, and it puts pressure on emerging markets that have borrowed in dollars. We could see stress in countries like Turkey or Argentina that have large dollar-denominated debt. Mortgage rates will rise. The 30-year fixed mortgage rate is tied to the 10-year Treasury yield plus a spread. If the 10-year goes from 4.3 to 4.8, mortgages go from around 6.8 to maybe 7.3. At 7.3%, the monthly payment on a $400,000 mortgage is about $2,750. At 6.8%, it is $2,600. That is an extra $150 per month, $1,800 per year. For a housing market that is already struggling with affordability, that is another hit. And here's the part that affects your retirement account. If you have a target date fund or balanced fund, you probably have a mix of stocks and bonds. A 60-40 portfolio, 60% stocks, 40% bonds. In a Warsh scenario, both parts of that portfolio get hit. Stocks fall because of valuation compression. Bonds fall because yields rise. A typical 60-40 portfolio could lose 5 to 8% in the first month after a Warsh confirmation. If you have $500,000 in your 401k, that is $25,000 to $40,000 gone. Not because the economy collapsed, not because companies stopped being profitable, just because interest rate expectations changed. Now, BlackRock manages trillions in 60-40 portfolios. They manage trillions in bond funds. They manage trillions in growth stock funds. All of those are exposed to a Warsh scenario. If the average BlackRock client portfolio loses 6% in a Warsh repricing, that is $600 billion in losses across their $10 trillion in AUM. $600 billion. Those are not BlackRock's losses directly. BlackRock still collects fees on assets under management. But clients notice when their accounts drop $600 billion. Clients start asking questions. Some clients redeem, pulling money out. And once redemptions start, asset managers face a problem. They have to sell assets to meet redemptions, which pushes prices down further, which causes more clients to redeem. It is a feedback loop. Now, I am not predicting that BlackRock faces a redemption crisis. They are too big, too diversified, too essential to the financial system. But I am saying that a Warsh appointment represents the worst case scenario for how BlackRock has positioned client money. And they are not alone. Every asset manager who bet on rate cuts in 2025 and 2026 is in the same boat. Vanguard, State Street, Fidelity, all of them. But BlackRock is the largest, which makes them the most exposed. So what does BlackRock do? They have a few options. Option 1, they start repositioning now before Warsh is even confirmed. They sell long duration bonds and buy short duration. They reduce equity exposure and increase cash. They shift from growth to value. The problem with this is that if they are wrong, if Trump reappoints Powell or chooses someone dovish, they will have repositioned into a defensive posture right before a rally. They will underperform. Clients will be upset. Option 2, they wait until Warsh is confirmed and then reposition. But at that point, everyone else is repositioning too. The market has already moved. They are selling at the bottom and buying at the top. Option 3, they hedge. They buy put options on stock indexes to protect against a sell-off. They use interest rate swaps to hedge bond exposure. But hedging is expensive and it reduces returns. The reality is that BlackRock is probably doing some combination of all three. Quietly reducing duration, quietly increasing defensive positions, quietly buying some hedges. But they cannot move $10 trillion without the market noticing. And once the market notices, prices move against them. This is the problem of scale. When you are that big, you cannot be nimble. Now let me connect this to history, because this is not the first time that a change in central bank leadership has caused massive market disruption. In 1979, President Jimmy Carter appointed Paul Volcker as Fed chair. Volcker was brought in specifically to fight inflation, which was running above 10%. Volcker's approach was brutal. He raised interest rates to 20%. 20%. The economy went into a severe recession. Unemployment hit 10.8%. The stock market struggled, but inflation broke. By 1983, inflation was below 4%. Volcker succeeded. He became a legend. But the cost was enormous. Millions of people lost jobs. Businesses failed. The pain was real. Kevin Warsh is not Paul Volcker. The economic situation today is not the same as 1979, but the philosophy is similar. If you prioritize inflation control above everything else, you are willing to accept economic pain to achieve that goal. And markets hate uncertainty about how much pain is coming. When Volcker was appointed, bond markets sold off hard. Stock markets were volatile for years. It was not until inflation was clearly defeated that markets felt safe rallying again. If Warsh represents a Volcker-style approach, even a milder version, markets will reprice accordingly. Another historical example. In 2006, Ben Bernanke replaced Alan Greenspan as Fed chair. Greenspan had been chair for 19 years. Markets were comfortable with Greenspan. They understood him. Bernanke was an academic, a scholar of the Great Depression, but largely untested in crisis management. When the financial crisis hit in 2007 and 2008, Bernanke had to make unprecedented decisions: bailouts, quantitative easing, zero interest rates. Some of those decisions worked, some are still debated. But the transition from Greenspan to Bernanke, happening right as the housing bubble was bursting, added uncertainty to an already fragile situation. The lesson from history is that central bank transitions matter. Leadership matters. Philosophy matters. And when markets are unsure what the new leader will do, they price in risk. That risk pricing means lower asset values, higher volatility, and potential losses for anyone holding the wrong positions. So what do? Let me give you specific, actionable steps. First, if you have significant retirement savings, look at your asset allocation. If you are in a target date fund, understand that those funds are often heavily weighted toward bonds as you get closer to retirement. Bonds are vulnerable in a rising rate environment. Consider whether you want to reduce bond exposure and increase short-term treasury bills or money market funds. T-bills and money markets adjust quickly to rate changes. Long-term bonds do not. Second, if you're planning to buy a house in the next year, understand that mortgage rates could go higher if Warsh is confirmed. If you can lock in a rate now, that might be worth doing. If you are on the fence about buying, you might want to wait and see what happens with the Fed chair appointment. If rates spike after Warsh is confirmed, housing prices might soften as affordability declines, which could give you negotiating power. Third, if you have student loans or other variable rate debt, consider refinancing to fixed rate now while rates are still relatively reasonable. If Warsh takes over and keeps rates high, variable rate debt will get more expensive. Lock in fixed rates while you can. Fourth, look at your stock portfolio. If you are heavily weighted toward high valuation tech stocks, you're exposed to a Warsh scenario. Consider diversifying into value stocks, dividend stocks, or sectors that do well in higher rate environments. Financials, for example, benefit from higher rates because banks can charge more for loans. Energy stocks are less sensitive to rates because oil demand is relatively inelastic. Fifth, build cash reserves. If markets are going to be volatile through 2026, having 6 months of expenses in cash gives you options. You are not forced to sell investments at a bad time to cover emergencies. You can weather the volatility. And sixth, pay attention. Subscribe to this channel. Follow financial news. Watch for the official announcement of Trump's Fed chair nominee. When that announcement comes, probably sometime between November 2025 and February 2026, markets will react immediately. You want to be ahead of that reaction, not behind it. Now, let me talk about the bigger picture, because economy meet history is not just about short-term trades. It is about understanding the long arcs of economic power. What we are watching is a potential inflection point in monetary policy. For the past 15 years, since the financial crisis, the Federal Reserve has been extraordinarily accommodative. Low rates, quantitative easing, emergency lending facilities. The Fed has backstopped markets repeatedly. Every time stocks fell 10%, the Fed stepped in. This created what traders call the Fed put, the implicit promise that the Fed will support asset prices. Investors got comfortable. They took more risk because they believed the Fed would save them. Kevin Warsh does not believe in the Fed put. He believes markets should be allowed to find their own level. He believes the Fed's job is price stability, not propping up stock portfolios. If a Warsh Fed allows markets to fall without intervening, that is a fundamental regime change. And regime changes are when wealth transfers happen. Wealth moves from people positioned for the old regime to people positioned for the new one. In the 1980s, when Volcker broke inflation, wealth transferred from borrowers to savers. If you had borrowed money at fixed rates in the 1970s expecting inflation to erode your debt, you won. If you saved cash expecting it to hold value, you lost. But after Volcker, that flipped. Savers won, borrowers struggled. Real interest rates were positive for the first time in a decade. Bonds became attractive again. The 1980s and 90s were great for bond investors because yields were high and inflation stayed low. If Warsh brings a similar shift, we could see wealth transfer from risk assets to safe assets, from stocks to bonds once yields stabilize at higher levels, from real estate, which is leveraged and rate sensitive, to cash and short-term instruments, from growth to value. Understanding these shifts and positioning ahead of them is how generational wealth is built. This is not about getting rich quick. This is about not getting poor slowly. If you are positioned for a continuation of the low rate, high asset price environment and that environment ends, you lose real wealth even if nominal values hold. Your portfolio might say 500,000, but if 500,000 buys less than it did 5 years ago because inflation ran while your investment stagnated, you got poor. Positioning correctly means preserving and growing real purchasing power, not just nominal dollars. Now, before we wrap, let me address one more thing. Some of you are probably thinking, maybe this is all overblown. Maybe Warsh will not be that hawkish in practice. Maybe he will moderate once he sees the economic data. That is possible. People do change when they get into power. The responsibilities of being Fed chair, managing a $16 trillion economy, might make Warsh more pragmatic than his writings suggest. But I would not bet on it. When someone spends years publicly advocating for a particular philosophy, when they write op-eds and give speeches consistently arguing for tight money and inflation control, it is usually because they genuinely believe it. Warsh is not a politician saying whatever is convenient. He is an economist with deeply held views about how central banking should work. If he becomes Fed chair, he will try to implement those views. The other possibility is that Warsh is not the pick. Trump could choose someone else. He could even reappoint Powell, though that seems unlikely given their history. If Trump chooses someone dovish, and someone who wants to cut rates and stimulate growth, then the whole scenario I just described flips. BlackRock's positioning wins. Markets rally. Borrowing costs fall. The regime continues. But based on everything we know about Trump's preferences, about the names being floated, about Warsh's prior relationship with Trump, Warsh is the likely choice. And likely is enough to prepare for. This is economy meet history. This is where financial markets meet the patterns that have shaped civilizations. And right now we are watching a pattern that repeats every few decades. A central bank transitions from accommodation to restriction, from supporting markets to fighting inflation, from easy money to hard money. The transition is never smooth. It is never painless, but it is necessary. And the people who understand it is coming, who position accordingly, who prepare their finances for higher rates and lower asset prices. Those people survive the transition. The people who do not, who keep expecting the old regime to continue, who stay positioned for rate cuts that never come, those people get hurt. You now have information that most people do not have. You understand the setup. You know what BlackRock bet on. You know what could happen if that bet fails. You know the timeline. May 15th, 2026 might not be the exact date, but it is close enough to start preparing. The question is what you do with that information. Before you go, if this video helped you understand something you did not know before, do 3 things. Hit the like button so the algorithm shows this to more people who need to see it. Subscribe to Economy Meet History so you get the next video when it comes out. And most importantly, comment below. Tell me your biggest financial concern about the next 2 years. Tell me if you are positioned for rate cuts or rate hikes. Tell me if you think Kevin Warsh is the right choice for Fed chair or the wrong choice. I read every comment, and your perspectives help me make better content. Also, check out the video I'm linking in the description about how the Federal Reserve lost control of inflation in 2021. It connects directly to what we just talked about and gives you the background on why this transition matters so much. Thanks for watching. This is Economy Meet History, where your financial future meets the lessons of the past. I will see you in the next one.